Welcome to This Explainer. Today, we're conducting a forensic autopsy of a market trap. We'll be looking at the exact microstructural mechanisms that allow institutional smart money to systematically transfer wealth from the uninformed public directly to themselves. This isn't just some market coincidence. It's a matter of precise mathematical design. So what actually happens behind closed boardroom doors when the public firmly believes a stock can only go up? To the untrained eye, a soaring ticker, record retail trading volume, and widespread market euphoria look like a generational wealth opportunity. But behind the glass of those institutional boardrooms, a completely different, highly calculated operation is taking place. There's a chilling clinical disconnect between emotional retail narratives and cold institutional realities. Let's look at this structural disconnect. On one side, we have the retail illusion fueled by euphoria, social media herding, and the absolute fear of missing out. The public buys the breakout. But the institutional reality operates in the exact opposite direction. For them, this massive wave of retail buying isn't the start of a bull run. It's a manufactured counterparty. It's carefully cultivated exit liquidity, created specifically to facilitate their own methodical liquidation. Section 1. Anatomy of a market trap. The psychology of the counterparty. You see, to distribute millions of shares at maximum prices, institutions can't operate in a vacuum. They strictly require an environment of absolute public optimism to execute their strategy. And we can rely on empirical data to track this. According to research from the Allied Business Academies, a market bubble follows a very precise psychological trajectory. It starts with the stealth phase, where smart money quietly accumulates undervalued assets. As we move into the mania phase, emotional herding, informational asymmetry, and overconfidence take the wheel. Driven entirely by retail speculation, asset multiples are pushed to dizzying, irrational heights. And the speculative frenzy perfectly sets the stage for the final blow-off phase. Section 2. The institutional liquidity dilemma. The mathematics of slippage. We need to look at the rigid, structural limitations governing smart money. It's the hedge fund's ultimate mathematical dilemma. When a retail investor decides to sell, they just click a button and their order fills instantly. But when an institutional giant managing tens of billions of dollars decides to exit a massive position, they face a severe structural obstacle. If a multi-billion-dollar fund dumps its entire position onto the open market all at once, that sheer volume of supply instantly overwhelms demand. The price would plunge, triggering catastrophic slippage and destroying their own profit margins. So institutions literally cannot just click sell. Their massive exits have to be executed slowly, methodically, and invisibly, often over weeks or even months. This brings us to the definitive fingerprint of the smart money exit, known as climax volume. In volume analysis, climax volume events mark critical turning points in a trend. In a parabolic upward moving market, these are the extreme volume spikes you see right at the very peak. They signify absolute trend exhaustion. It's the precise moment when institutional distribution finally permanently overwhelms that last, desperate wave of retail buying. Section 3. Dark pools and hidden execution. The architecture of exclusivity. To execute this massive distribution without tipping off the retail public, institutions use off-exchange architecture designed specifically to keep their actions hidden. These are known as dark pools. Dark pool exclusivity refers to alternative trading systems designed to intentionally exclude retail and certain high-frequency traders. Their clinical utility is undeniable. They match massive institutional block orders without ever displaying quotes to public exchanges. This exclusivity prevents order flow information from leaking. If the public saw the true size of the institutional sell orders, the stock would crash prematurely. Dark pools keep the public entirely blind. The evidence for this is structurally embedded in the system's architecture. Mathematical tree diagrams, such as extensive form blueprints from Bocconi University, outline the complex routing logic of a limit order book operating alongside a continuous dark pool. It's mathematical proof showing exactly how institutions maneuver through parallel markets to quietly distribute millions of shares, completely bypassing the retail ticker tape. And the scale of this shadow market is staggering. Consider this. The SEC proposed a size discovery exemption threshold for indications of interest, set at $200,000. This proves unequivocally that these alternative trading systems aren't meant for standard price discovery. They are built explicitly for elite, high-volume players to transfer vast amounts of capital totally unseen by the broader market. Section 4. The regulatory paper trail, decoding Forms 13F and 4. If you want to survive in these markets, you have to abandon emotional media narratives and charismatic internet commentary. You must look exclusively at the mandated legal evidence of ownership transition. Welcome to the evidence room. Under federal securities laws, we can track this transition by monitoring Form 13F, detailing quarterly institutional holdings, and Form 4, which records corporate insider transactions. By reverse engineering 13F filings alongside that continuous stream of insider selling forms, a chilling divergence emerges. Right during periods of peak public optimism, we observe a massive surge in insider selling and hedge fund liquidations. It's an undeniable, legally mandated map of the wealth transfer. Furthermore, comparative variance analysis measuring market quality between transparent order books and dark pools reveals a highly systematic strategy. The data shows exactly how institutions maintain artificial price stability in public markets. They keep the spread tight and the public confident on the lit exchange, all while aggressively and continuously liquidating their actual positions in the dark. Section 5. Withdrawing artificial price support. The floor collapses. Once the institutional distribution phase is mathematically complete, a structural inevitability takes hold. You have to learn to spot the signatures before the collapse. According to Deep View volume analysis, accumulation is characterized by tight, quiet price action with higher volume on up days. Distribution operates fundamentally differently. Distribution shows high volume with little to no actual price progress and heavy volume on down days. When you spot this distribution signature, you are witnessing the trap springing shut. The brutal reality is this. When the institutional giants have finally unloaded their overvalued equities onto the public, they completely withdraw their price support protocols. The algorithmic trading systems that were actively keeping the stock elevated are simply turned off. The asset enters a state of absolute structural vulnerability. Because there are no longer any institutional block buyers waiting at the bid to absorb selling pressure, a simple corporate miss or minor economic shift triggers uncontrollable panic selling, and the price experiences a vertical collapse. Section 6. Surviving the wealth transfer. The objective strategist. To navigate these cycles, you must abandon cognitive bias and align your capital strictly with the empirical data. In the wake of a collapse, retail investors consistently fall into predictable structural traps. They experience paralysis driven by cognitive bias. They fall victim to the sunk cost fallacy, emotionally averaging down on a broken asset. And they do this completely unaware that they are simply acting as the final, desperate providers of exit liquidity for the smart money that has already left the building. The wealth isn't destroyed, it's simply transferred to uninformed hands. We leave you with this absolute maxim. If you do not know how to track the paper trail of smart money, you are destined to become the liquidity for their exit strategy. The choices you make with your capital require calculation and psychological fortitude. The trap has been exposed. The only question remaining is this. The next time the market euphorically insists an asset can only go up, whose exit liquidity will you be providing?